hello, business builders, and welcome to Business for Breakfast, where business is the most important meal of the day. I'm your host, Aaron Novinger, the Venti business guy. Our goal in this channel is to give you a ton of micro lessons to help you mind your own business. Hang out with me today as we drive and dive. We dive into topics that every business owner, especially us mom and pop Venti shops, need to hear. So today, it's all about small business taxes. Buckle up and let's roll. All right, my goodness. So this is part 2 of the Biz Tax Crash Course 201. And today, oh my word, I'm so excited about the topics. Okay, so today's lesson, and I think YouTube is going to put this in chapters because I want it to be like a reference we can go back to. Because remember, the reason why I'm doing this, first of all, Rebecca and I are one of the few accounting firm owners that are not accountants. We're small business owners. We know what the pains of our small business owners are and our entrepreneurs when they know it, and we usually know it before they know it, right? Because we know it. And the whole purpose of all of this is because I was railroaded in the past by accountants that didn't do their job, that waited too late, that filed things late, and blah, blah, blah. And so for us, the main goal is to really equip you as an owner to really be able to take a lot of this stuff into your own hands. And so much of what we need as owners is just that knowledge. And so all we want to do here is just do knowledge transfer. That's all we're doing here, okay? But today, we're going to make sure we're going to understand and we're going to implement tax deduction strategies for small business owners. We're doing that in today's micro lesson. We're going to differentiate between legal entity types and their tax classifications. We're also going to do some calculating of self-employment taxes, savings through S-Corp election, OM of the G, that's a biggie. Apply payroll strategies to optimize tax efficiency, guide small business owners in selecting the best retirement plans, and we're also going to utilize the tax calculator, and we're going to do some retirement planning. So it's a little bit of planning at the very end. So this is what we're going to be, those are the main topics for today's lesson. An overview of our tax strategies for today. We're really going to focus on 3 primary phases, right? Maximizing our deductions, okay? We're going to looking at tax classification optimization, and then of course, one of my favorite topics, retirement planning. The main learning objectives that I want us to pick up today to make sure that we have a good handle on is really, I want you guys today to learn about home office deductions, tax classification choices, and I'm talking specifically like sole proprietor, partnership, S-Corp, stuff like that, and retirement saving options, right? So IRAs, SEPs, solo 401ks, things like that. So let's jump into this and jump straight into home office deductions. So this will be, I don't know, topic 1, home office deductions. So when we're thinking about home office deductions, okay, we have to have understanding that there's 2 primary ways that we look at deductions. And you know this by doing your personal tax return, right? You've got standard deductions, right? And then we have itemized deductions. That's what we have for personal. For business, we have the simplified method, right? Or the regular method, okay? And we're talking about home office deductions, the same thing. We have a simplified or a regular method. So simplified, okay, is $5 a square foot, max 300 square feet, which is a 15 by 15 room, a corner room. And if we do the simplified, it's capped at a $1,500 deduction, right? So $5 times 300, $1,500. Regular method, okay, remember like your personal taxes, the standard deduction or the itemized. So regular method would be like itemized, okay? So it's the deductions for the mortgage interest, HOA fees, the utilities, home repairs, security systems, and then basically the depreciation based on a business use basis and percentage, okay? So you understand the difference between the two. One, if you are ridiculous at keeping your receipts and you're just one of those that kind of has an OCD-ness about numbers. Regular might be good, and then you got simplified. Very similar to, and we'll talk about auto here in a little bit because auto is very similar. But we've got mileage logs where we can just take a simplified amount, or we can break everything down. The IRS is flexible in how we take these deductions, okay? And I will tell you that this used to be a huge misconception, misunderstanding, because the home office deduction years ago was once considered a red flag for an audit. And if you guys remember, I told you guys the story on our BizTax Crash Course 101, the last video, where I told you guys that we got audited in 2007. And if you remember what I told you, when the IRS lady, when I picked up the phone and she introduced herself, they have to by law tell you what flagged you for the audit. And what did she tell me? It was my mileage logs and my home office deduction. But we all know that since 2020, and by the way, this was in 2007, right? So I think we have a pretty good understanding that 2007, back then, was like, if people work from the home, it was like, oh, they did like home-based businesses, or they were doing stuff like that, or they were basically running off their home because they were doing network marketing. It was like, that's the way it was back in the day. But now really because of COVID, it's like, are you serious? I don't know. I feel like 1 in 4 workers is either working full-time from home or doing flex schedule. You see what I'm saying? It's not a red flag like it used to be, okay? Now, let's talk about auto deductions, okay? Again, 2 deduction methods, okay? We have the standard mileage rate, which I was just telling you guys about, right? And then we have the actual expense method, right? It's one's take the easy route, one's the itemized route. Easy, itemized. And that depends on you, okay? And it also depends on how much we have for itemized. You get what I'm saying? It's the give or take. And that's why if you've got a pretty decent accountant, they're gonna help you navigate that. We've been doing small business accounting for almost 60 years. So our bread and butter at our practice is the mom and pop Venti shops, but we're not the only game in town, by the way, okay? So there's lots and lots of great accountants that love small business that know this stuff, okay? Just make sure you have one. That's all I care about, okay? Now, let's talk through some of the rates, right? So the standardized rates, I believe for 2025 is like 58, 59 cents per mile. Typically it's best for vehicles that are like under 40, 50,000 dollars driven, I don't know, like more than 12,000 miles a year. Business miles, by the way. So standard mileage rate is good for that. Like the vehicle's under 40K, but we drive a lot, okay? Now, let's talk about actual expense method. That's where we do things like deduct the fuel, okay? Our insurance, lease payment, right? Let's see, what else? Maintenance and depreciation, okay? Same thing we're talking about with the home office, right? Okay. Now, here's the kicker with tracking. If you remember when I told you guys about my IRS audit in 07, mileage logs and home office deduction. And it wasn't mileage logs, it was mileage expense, okay? And I want you to hear me here, because you're talking to one of the few guys that has been through not 1, but 2 IRS audits, okay? Here's what they do with the mileage log. And by the way, there's tools today. Back in the day, we didn't have apps, okay? So when I got audited, the very first thing that they did, because it's what flagged me for an audit, was my mileage deduction. She said, I need to see your mileage logs. I said, cool. And so give them to her. Now, I told you guys, my mother-in-law is a semi-hoarder, okay, in a good way, okay? She kept really good records of everything. So the very first thing the IRS does when they come in for an audit is, yes, they line item everything in your bank statements for all 12 months. Every item is line item with a highlighter. Every item, okay? That's what I told you guys before. Everything you spend money on, can you defend it in an audit? That's the question you always gotta ask yourself. If I get audited, can I defend this? If I get audited, can I defend this? Okay? I'm just telling you, it'll make your life about 1 billion times easier, okay? But going back to the mileage log, I handed her, we had 3 cleaning crews, okay? And we had 3 vehicles for the cleaning company. Handed her all 3 mileage logs, and she goes, oh, whew, these are really great mileage logs. And she said, but here's the thing. When you said you went to Walmart to get supplies. Just show me the Walmart receipt. When you said that you went to the bank to make a deposit, just show me the bank deposit slip. When you said that you went to do a job, just show me the invoice. When you went to bid a job, just show me the estimate. I'm not kidding. They make you prove every mile in the mileage log, okay? And I could not prove 5,000 miles. 5,000 miles. 3 crews all year. I don't know how many tens of thousands of miles we drove, okay? It was insane. Nope. I could not prove 5,000 miles. And when you have an IRS audit and there's a discrepancy in that audit, which there always is, it's an automatic flag for the next year's audit. That's right. That's right. So I was audited in 05 and then audited in 06. So we're talking back about mileage logs. There's apps out there now that are fantastic, okay? QuickBooks actually has a mileage app. I'm not a big fan of QuickBooks, to be honest with you, but I know they have a really good mileage app, okay? So now, S-Corp considerations, okay? Mileage from home office to business. Did you hear that? If you're an S-Corp, okay, and remember, typically most mom and pop Venti shops are either sole proprietors, like 1040 Schedule C, sole proprietors, or LLC, sole proprietors, okay? Most of our small mom and pop Venti shops don't even really know the difference between a C Corp, S Corp, and all that stuff. But S Corp's, one of the benefits of the S Corp is the ability to write off the mileage deductions between the offices, which is really cool, okay? Now, can we move into cell phone and internet? I love me some S-Bucks, S-B-U-X, my fave. Cell phones. All right. Obviously, if it's a separate line, 100% of it, up to 100% is deductible, okay? If a separate line exists, right? If you have, I have a lot of my friends that have 2 cell phones, right? They have a cell phone, they're personal, and then they have a cell phone for work. And so obviously 2 phones, and the company does that so they can literally expense the cell phones, obviously, right? But if it's personal, okay, we're able to basically do up to 80%, okay? So for personal use, right? So max 80% deductible if the phone, personal phone, is used for business purposes. Cool? Okay. So 100% if it's a separate line, up to 80% if you're like me, that this darn thing that I live off of, I literally would say 80-20. Like 80% of what I use it for literally would be business, okay? I would say that's probably, if you basically eat, breathe, and sleep your business, most everything you do is 80-20. 80% of what you do, 80% of the conversations with your spouse, if you and your spouse have a business together, like Rebecca and I do, are you kidding? Every meal that we have, we're talking business. Every conversation we have is about business. Most of the time we have to travel, it's about business. Like, it's just, so the good and the bad, obviously, is because you do it together, so you're able to write things off, right? But the bad is also that you don't really get a break, and you know, I'm beyond lucky and blessed. I love working side by side with my wife. We've been together almost 30 years, so she's like my best friend, and she's really amazing at what she does at the practice. It's really cool. But again, there's pros and cons, right? There's pros and cons to everything. Compromises to everything, right? So it's not really good or bad, it's just compromises. What's the compromise for this? What's the compromise for this, right? All right, now, so internet, typically we're looking between 50 and 80% deductible, excluding bundled entertainment services, right? So follow me here. If you're an internet provider and you also get like your Netflix, your Disney, and your Hulu through that, and you pay one bill and you try to slide it in, I can tell you right now, if you don't tell the accountant this is for the personal membership subscription stuff and this is for the internet, fine. And you don't separate that, then they're going to put it for internet. That's fine. But if you get audited, that's coming up. Understand that. It's coming up. Just keep in the back of your mind. All right. Now, let's talk about, I don't know, one of my favorite things to talk about, food. Let's talk about food, baby. Let's talk about you and me. Let's talk about all the food that we can eat. What's the rest of the song? I don't know. Baby, let's talk about food. I don't even know most of that. All right, let's talk about business meals deductions, shall we? Okay. Meals, prospects, clients, vendors, employees, right, are deductible. Not personal or date night meals, okay? Now, so that's what I said before. You got to be careful, okay? Because everything you do is, especially if you're married and you have a business together. I have a lot of my friends actually that run, the husband and wife do the business together. And trust me, ask them. Every minute of every day, every conversation, there's something about the business, right? Okay. So now, let's talk about deductions, okay? Now, for food and meal, I believe it's now 50% of it is deductible. But we've got to see what's going to happen with the new administration, and are they going to keep some of these tax deductions that we have, or new ones coming? So right now we're looking at 50%, but just keep that in the back of your mind because I think things are going to be changing soon. Let's talk about travel deductions, okay? Business travel, obviously. So this is going to be your flights, hotels, taxis, right? Business, day-to-day meals, all fully deductible, okay? And it's great if you have to travel for work, or if you have a bunch of offices and you're always traveling, okay? It just makes sense that you wouldn't have to spend that money if you didn't have to travel for business. Obviously, it makes sense that all of that would be deductible, but just keep it in the back of your mind. Now, mixing business and personal travel, okay? If, let's say, it works out, let's say you're on the weekend, okay, you're going out, right? I'll give you an example. Let's say you've got a long weekend trip planned to, one of Rebecca and I's favorite place to vacation is Carmel, California, okay? You guys remember the story I told you when I got the call from the IRS auditor? I was walking the streets of downtown Carmel, California. Okay, it's a magical place, love it. And so let's say you're gonna go on a Saturday, Sunday, okay? Here's the deal. If Friday and Monday, so you go, I'm gonna go Friday, Saturday, Sunday, Monday, okay? If you work at least 4 hours of business activity, right? The entire trip, including the weekend, is deductible, okay? We gotta have at least 4 hours of business activity, the entire trip. And if you know anything about us, literally everywhere we go, we're always handing out our postcards about what we do for our accounting office. And we do, all of our office managers and accountants are amazing. And so a lot of what we do is like remote login. So we have clients all over the place. But that's what I'm saying, wherever we go, like a couple years ago or last year, because we plan on going West Coast and opening up offices. So we literally did a road trip going all these different cities. Okay, what about here? What's their small business population look like? Should we, okay, so demographically wise, is what we're looking at. Because again, you guys know for almost 60 years, our bread and butter has been the mom and pop Venti shops, which are 1 to 20 employees. Now, obviously we have businesses that have hundreds of employees, but I'm just telling you, we're specialists. We know that segment very well. All right, now, let's talk about, oh my gosh, one of my favorite things to talk about on planet Earth is hiring those tiny little midgets we call kids, okay? Now, I'm not being offensive at all, because it's okay for me to call my kid that, okay? But you guys I'm talking about, they're just little annoying little dudes that just constantly are wanting, they're like the suckerfish on the whale, right? I don't know what, well, I was gonna say, I don't know what the deal is, but I do know what the deal is. That when I was growing up, both of my parents were like in the military, and so we weren't poor, we were po', okay? We were po'. I didn't even have enough money to finish the rest of the word, okay? But you gotta remember, growing up for us, the reason I started my first business at 13 was out of necessity, okay? Because already growing up, I was at that age where we were so poor that we would do our shopping at the commissary. Again, parents in the military. Why? Because it's tax-free. But I am not kidding. I remember getting Bugle Boy and members only when it was already out of style, okay? I'm not kidding, all right? But we literally are once a year for clothes shopping for school, and I think our parents gave us like $100. You understand, even back in the 80s, $100 was no money, okay? A pair of Gerbeau or Cavaricci jeans, that was like $75, man. And trust me, so I so badly wanted those, but no, the commissary never has that. Anyway, I digress, right? But you're talking about back then, oh my gosh, stuff is sliding off my little thing over here. But when we were growing up, and then we had our birthday and Christmas. That's the only time we got money growing up. And so honestly, for us to have anything we wanted, I literally had to work. And so I literally started my first business out of necessity because I wanted to buy stuff and my parents didn't have any money, okay? But today's time is different. I don't know. I feel like Gen Z, Gen Alpha generation, maybe not necessarily millennial, but I do see a little bit of a lack of drive overall. Now, I say that with a grain of salt because both my kids have worked for me and I would hire them tomorrow. Okay, so both my kids have great work ethic, okay? This has nothing to do with that. But you as a business owner, we always want to teach our kids the value of $1 and we want to teach them the value of hard work, okay? So we're very big on having the kid help out, right? So my kids both would help out in office and scan stuff and things like that because we need help, right? And you pay a little money too, right? So here's the kicker. Hiring your kids, okay? So typically, I literally have people that will hire their newborn kids, okay? And then literally, instead of paying them the money, okay, they put it into their own beneficiary IRA for their kids. So you can do cool things like that, okay? And so literally as kids, you can be doing photo shoots and then pay them all that money. Okay, so now, but typically best if you can put the kids into the office. So usually between age 7 and 17. That's a good range. 5 to 17-ish, 7, 8 is when kids can actually start helping out. Here's some of the big benefits, right? So instead of paying for a child's expenses after tax, okay, what we're just talking about, we need stuff, right? They earn wages up to, and I think it's $13,000 now, tax-free. Okay, because with the kids, every year amps up a little bit. I haven't checked 2025, but it's always been that 13 to 14,000 range. Okay, a couple years ago it was 12,000, but it just each year kind of incrementally increased a little bit, right? We have to make sure that we don't exceed the tax-free threshold. But remember, children don't actually need to file tax returns or taxes if their earnings stay below the standard deduction. Whatever the standard deduction is, 13,500, 14,000, okay? We just gotta stay below that. So you guys understand this, right? Pay the kids, hey, you want something? Come to work. You want something? Come to work. Earn it. Earn it. Earn it. Earn it. Come on, man. We have lost this merit-based mindset. We gotta earn. We gotta earn it. So anyway, but work requirements, okay, let's talk through that. So like we were talking about before, age-appropriate work, right? So if you got a 10-year-old and you need stuff, it's really easy to put kids to work in an accounting office, I swear, because we have so much paperwork and scanning and crap that we have to do that it just is very easy, okay? But I'm just telling you, put the kid to work in something that's appropriate. Remember, in your mind, can I defend this in an audit? Can I defend this in an audit? I just want you thinking that, okay? Now, let's move into health insurance deductions, okay? If you are an owner of an S-Corp, right? We must include premiums as W-2 wages, okay? But it's not subject to the FICA taxes, right? The Medicare Social Security 15.3% savings. What's the 15.3% tax, which means it's a 15.3% savings, which means for every $1,000 we just saved $153, okay? Trust me, it ain't chump change. It's a lot of money, okay? Now, for sole props, we can deduct 100% of the premiums, but only from income tax, okay? Not self-employment tax, okay? So we deduct 100% from the income tax, not the self-employment tax. Self-employment tax, 15.3, okay? Cool, all right. Let's talk about miscellaneous deductions, and we're gonna cover a bunch, okay? So usually, and these are ones that are often missed, okay? And so these are gonna be like memory joggers for you. But think of marketing and advertising. And when I say marketing, real estate is a biggie because Rebecca's got a real estate license, and all the time, they're limited to giving gifts of $25, like no more than $25, okay? Which, by the way, I think is cool, so that way there's not like a bunch of like bags of cash going under the table, so it keeps everybody straight. But you understand, if you brand your stuff with your name, your website, or a logo or something, that's not a gift, it's a marketing expense. You know that, right? Did you know that? I don't know if you knew that. Just understand that if you're in an industry that basically caps you from what you can give as a gift, if you put your logo and everything, if you've got like a certain thing, like a coffee mug or something, I'm just giving you an example, and it's not that's even expensive, but something that somebody's going to use a lot, but you put your name on it, like, right? That's a marketing expense. That's different. That you're not capped at $25, right? Bank fees, right? All those pesky fees that we have every month, the wire fees that we have. Now, banks charge us to not only send, but receive wires. It makes no sense to me. I mean, banks are just the biggest ripoff on planet Earth, right? But let's see. Now, going back to business gifts, we can still write them off. We get that, right? But typically it's limited to $25, right? Again, unless it's branded as a marketing expense. Cool? Okay. How about business insurance and interest on business loans? Yes and yes. And don't forget, all businesses should have a Fokker Circle of Trust, okay? I am obsessed with the Circle of Trust. I have a business Circle of Trust and a personal Circle of Trust. If you look at my phone, on my favorite contacts, if you're in my circle, you have a circle by your name. I'm not kidding. So I'm big on circles of trust. But if like all the greats in business had an executive council, okay? Some variation of that. So here's the thing. You understand that if you have a board of advisors, people you lean on, right? Those expenses are deductible. It's true. Now, can we talk a little bit about optimizing our tax classification? So let's move into the next section of this 201 Biz Tax Crash Course, okay? So now, I told you guys this in the last course. When you form an LLC in your state, by default, the IRS deems you a sole proprietor. Because you have to remember, an LLC, people are like, I'm an LLC. People have a hard time understanding that there are state qualifications and then federal qualifications, okay? So an LLC is recognized by the state, not by the IRS, okay? So there is no such thing as a LLC classification when it comes to taxation with the IRS. It doesn't exist, okay? What does exist is sole proprietor, right? What does exist is partnership, S Corp, C Corp, nonprofit. These all things exist with the IRS, just not an LLC. So if you form an LLC, and so many of our entrepreneurs are, you don't even realize by default, you are the highest taxed entity in the United States of America, which is a W-2 employee. All true. All true. Remember what I told you in the 101 course? The reason why the United States of America has more money they know what to do with is because they have the greatest revenue collecting system anywhere on planet Earth. There are more, remember, the highest tax entity in the United States of America is a W-2 employee. And a sole proprietor is just a W-2 employee of your own business. It's true, playa. You're just a W-2 employee. It's even worse, man, because when you work for a company, at least the company pays half of your self-employment taxes of 15.3, but when you're self-employed, you gotta pay all of it, man. All of it. It's horrible. You just get railroaded all over the place. And the Irish is like, showing up, we want our money. And the state's like, we want our money. And you're like, I'm just trying to make money. This is the life of all of our owners, man. It's an absolutely exhausting, it's a day in the life of what we have to do. I've said this all the time, my whole life. Most days, I wouldn't wish the hell that we go through on our worst enemy, but there's other days where I wouldn't trade it for the world. That, I don't know, man. That's the beauty and the torture of having a business, right? Now, so we understand a sole proprietor, right? You have a 1040 and you file a Schedule C on your 1040, and you're going to pay 15.3% for self-employment taxes, right? Now, remember, single member LLCs. So when you go to the state, you form an LLC, you're either going to be a single member or a multi-member, okay? Single member LLCs, by default, tax is a sole prop, right? Okay. But in a sole prop, again, it's just a W-2 employee of your own business, right? But again, you can elect, listen to me, if you will hear this one thing, the next 30 seconds, if you will take 1 hour to do what I'm about to tell you, it's gonna take me 30 seconds to tell you, hand to God, you will save thousands, if not tens of thousands this year in taxes. Remember this, write it down, stop your car, I don't care what you're doing. If you're at church, excuse yourself, write this down. If you have an LLC and you are either taxed as a sole prop or a partnership, immediately stop everything and you will form and file Form 2553 with the IRS, which does what? Elects you as an S Corp. Come on, playa. Woo-hoo! We instantly save that money in taxes and we reduce our chance of an IRS audit by 95%. I'll talk about that later, okay? Now, C Corps. Oftentimes they're subject to double taxation because the entity itself is a taxable entity, but then the owner gets paid and they have to pay taxes. So that's why they say it's like double taxation, right? It's the corporate tax plus the personal tax on the dividends, okay? Now, why choose an S Corp? So it's like, why? People say it all the time. Okay, there's a couple reasons. One, we immediately save on the self-employment taxes. Immediately, okay? And so what I mean that is typically whenever you're, again, when you're a sole prop, okay, every single penny in profit, the IRS looks at it as a paycheck, W-2. And so you have to pay all 15.3% of self-employment taxes. Cool, okay. Now, as an S Corp though, it's different because we do a divide. Now, one of the biggest issues the IRS is having, we learned this actually in last year's tax class, was not enough S Corp owners actually taking W-2 paycheck. And this is the key. So as an S Corp, you're able to really get paid two ways. W-2 and then distributions. W-2, distributions. Got it? Okay, cool. Now, understand, we've got to pay ourselves something, okay? If you're working in the business, the IRS is expecting, if you weren't working in the business, you'd have to hire somebody, right? Okay, cool. How much did you pay that person to do that job that you're doing? Okay, I answer the phones, I run the front desk, honestly, probably, I don't know, 15 bucks an hour? Okay, cool. So take 15 bucks an hour times 40 hours a week, okay, 600 bucks, right? That's gonna be about 32, 33,000 a year. Cool. So let's say last year you were a sole prop and you took 100,000 bucks. You paid 15.3% in taxes right off the top, plus whatever your tax bracket was. Cool, got it, okay? So probably your marginalized taxes was probably in the 18, 20%-ish, plus the 15.3, okay? But you go and you listen to AA Ron over here, and you go and you file your Form 2553, become an S Corp. Now the next year, out of the 100,000, still taking 100,000, 35,000 of it will be W-2, and the rest of it is going to be a distribution. And that distribution is not susceptible to the self-employment taxes of 15.3. What? Come on, playa. Can I get a woot woot? Come on now. You know what I'm talking about. So what I'm saying is basically, here's your break-even point as an S Corp for W-2 and blah, blah. Think 40,000. If you're taking more than 40,000, 35, 40,000, somewhere between 30 and 40,000, okay? Divide and conquer, right? Let's do a salary versus distribution, right? Like we were just talking about before, $100,000, and let's say 40,000 of it is W-2 salary. We're paying the self-employment taxes on, right? Paying the IRS, the payroll taxes for that. It's like you're a W-2 employee of your own business, right? But then the rest of it, we take distributions, okay? And so that really allows us the ability to maximize our tax savings. And this is the reason why, and trust me, when we do tax returns, and we do a zillion of them, if we see sole props on there, we're having consultations with our owners. Hey, go ahead and sign this Form 2553, or we're gonna save you money day one. Okay, so that's a big thing. So now here's the kicker. If you pay yourself too much of a salary, it really reduces the S-Corp tax benefits. So using the 100,000 again, if you paid yourself 85,000 W-2 and took 15,000 distribution, I don't even know if that's even really helping you a whole lot, to be honest with you. Okay, it's reducing your chance of an audit, but is it really helping you? You get what I'm saying? Okay. Now, here's the other thing. Paying yourself too little can definitely trigger an audit with the IRS. And I'm telling you, this was a big topic, not in the 2024 tax class, but the 2023 tax class. We talked extensively about the IRS cracking down on S-Corps that are not taking W-2. Now remember, if you're not actively working in the business, you can take a distribution. Because remember in your mind, can I defend this in an audit? Can I defend it in an audit? That's all you have to do. That is the litmus test that will basically save your can. You get what I'm saying? Okay, cool. Now, let me think here. Okay, my gosh, did we cover everything? I think we did. Okay, so let me just wrap this thing up. We've been on for almost 40 minutes, okay? A couple key takeaways I want you guys to grab from this, right? Number one, strategic tax planning, okay? I think we get this. 100% can definitely save you guys a ton of money, and I'm talking like 10,000 plus per year in taxes, okay? Electing the S-Corp is going to definitely maximize your tax savings and efficiency. I think we get that. I think I've beat that horse straight into the ground, okay? Make sure, another key takeaway, proper deduction tracking, right? Home office, auto, meals, travel, plus all those other miscellaneous ones I talked about is gonna really make sure that ensures IRS compliance, because I promise you, when you get audited, they ask for the proof. Just trust me on that, okay? And another biggie, hiring those little kiddos and optimizing your salary. I'm telling you right now, it is mind-bendingly powerful employing those kids for even 5 to 10 hours a week on what it does for them, how it changes them. I'm telling you, I've seen this. I got some of my business owners where their kids are like basically like trust fund babies already, and by the time they turn 16, they're driving a brand new BMW. Compared to, I don't know, my kids. My kids are fantastic, okay? But they also worked, okay? So my kids literally like $5,000 cash car, right? Rebecca and I just did it different. And by the way, I'm not saying one way is right or the other. What I'm saying is if the kids don't have to learn certain things, then they won't appreciate certain things. You see what I'm saying? Okay. Now, the very last thing that I want to talk about, and I told you I was going to talk about this, is the retirement accounts. Okay, so this is, and I'm going to wrap this thing up. Actually, I'm going to talk about that in 301. Okay, so a little cliffhanger for you. We will talk about the retirement accounts in course 301. With that, guys, I think we basically turned on a fire hose of information. Look, if you guys remember even 10% of what I said, but I want this to be a resource for you. I want you to keep coming back to it, and I'm going to keep giving you guys insane content because nobody helps us. No one, man. You guys get this. Hardest working people on planet Earth, most underpaid, usually in the worst health, are mom and pop Venti shops. Why? Because they don't have the money or the resources to hire people that are experts in everything else. That's why I always say the SBA says a small business is 0 to 500 employees. That is horse crap, okay? There is an enormous difference between a business that has 500 employees, a business that has 50 employees, and a business that has 5 employees. Tracking, you know what I'm talking about, okay? And here's the kicker. Once you get somewhere between 25 and 50 employees, you start having the resources and discretionary revenue to start hiring consultants, full-time, part-time, employees, part-time, full-time, that are experts in things that you need help with, but not us mom and pop Venti shops. Nobody helps us. That is the purpose of this channel. That's what we do at the practice. It's just teach, consult. We want to, so much of what we do is just knowledge transfer to you as the owner. So that way you guys are empowered and you're not just having to listen to everybody that's taking advantage of you. We want to change that. We want to fix that. So with that, guys, I'm going to wrap up. I thought we had an awesome class today, micro lesson on all these different tax classifications. And with that, I'm gonna jet, because you know what time it is. It's time to get to work.